to PhillipCapital Weekly Market Watch. I'm Yin, Business Development Dealer at Phillip Futures. For this episode of Market Watch, I will be discussing on the gold outlook for Q4, focusing for next year 2015, and my recommendation using the technical analysis. First of all, I'll be discussing on the gold demand for this Q4. Gold prices has fallen hard on the speculation that Federal Reserve is likely to increase the interest rates for the first time in 8 years after ending its monthly bond buying program. With the Fed likely to increase the interest rates, investors are selling their positions on gold and switching back to the greenback. The heavy sell of the commodity has led to gold hitting its lowest price of 1132 in the last 3 years. Apart from the increased interest rates, gold faces another threat in the form of central banks taking measures to spur the US dollar growth. In Switzerland, voters have rejected on the Swiss central bank doubling its storage for gold. Had the outcome has been a yes, the gold prices are expected to rally up. However, with the voting against gold deals, Switzerland has set the gold prices to the lowest, adding more reason to the investors to be bearish on the precious metal. However, not all is gloomy for gold, as the People's Bank of China has kept interest rate, sending the gold price on a rally. Over the euro, the Central Bank of Europe is also ready to expand its stimulus program to raise the inflation. Okay. So moving on, I'll be doing the forecasting for the gold demand for the next year. As you can see from the gold chart, gold has hit its lowest point of price at 1132 on November 7th of this year for the past 3 years. According to the World Gold Council, the global gold demand in Q3 was the lowest ever in almost 5 years. Hence, gold prices are still likely to remain vulnerable in the near term. So, in the long term, the gold prices are still expected to be in the downtrend, with the price moving between 1141.70 for the support and 1157.39 for the resistance for the coming year, as the strengthened dollar will still soften the demand of gold. Moving on to the technical analysis, looking at the gold chart daily, we can see that there is still a downtrend in that, with the Fibonacci retracement suggests that the gold prices are supported at 1141.70 for now, with the resistance at 1157.39. As you can see from the chart, the relative strength index RSI is moving just above the oversold mark, and there is slight possibility that this trend will reverse as the MACD is moving just near the signal line. However, with the Switzerland news voting against the storage of the gold reserve, we can see that the MACD is actually moving away from the signal line, and it gives us a bearish sign for the investor, saying that the price is going downtrend. So expectations of higher borrowing rates going forward is considered bearish for gold, as the precious metal struggles to stay competitive while the rates are on the rise. Gold is on course for the first back-to-back annual drop since 2000 as the Fed Reserve moved towards raising interest rates. China has kept interest rates, and Japanese has actually boosted its stimulus last month. Since June, the European Central Bank has also kept rates, offering long-term loans to banks and bought back asset-backed securities. With the Bank of China a softer dollar, holding the gold price steady for now, however, the dollar strength will still limit the rally of the metal. In conclusion, my opinion on gold performance for next year is bearish. The fundamentals are unlikely to support gold demand at the year end as the dollar continues to strengthen. Demand from China and India are also not enough to halt the gold slide. There is possibility that the gold price will recover as the precious metal is supported by China cutting interest rates and EU adding the stimulus. However, the overall outlook for gold demand for the next year is not looking great, and we still need to stay tuned for the Federal Reserve decisions on the interest rate. So we have come to the end of this week's Market Watch, where we have discussed gold. For more information on the risks and returns of investing in gold, you may approach any one of our representatives from Phillip Futures for further discussion. With that, I have come to the end of my Market Watch this week. Please subscribe to us on PhillipCapital YouTube channel and Facebook, and stay tuned for more Market Watch videos next week. Thank you.